US dollar to Japanese yen has surged back above 155, effectively countering the immediate effects of the Ministry of Finance's staggering $65 billion intervention during Golden Week. Even with Tokyo executing two significant liquidity rounds, the market remains bold, testing the resolve of the authorities. In today's analysis, we'll delve into how the latest wage data reinforces the Bank of Japan's tightening narrative, yet struggles to halt the yen's descent. What does this mean for your positions in the Nikkei and JGB? Stay tuned. As we approach the May holiday, the Ministry of Finance has been vigilant, especially as US dollar to Japanese yen dipped below 160, its lowest point in decades. There were high expectations that breaking below 155 would trigger aggressive selling from the MOF's currency desk. Traders anticipated a line in the sand strategy, with positioning data revealing heavy yen shorts but also a growing concern about potential stealth intervention amid thin holiday liquidity. The consensus in Tokyo was clear: a significant liquidity injection could pave the way for a temporary trend reversal, giving the Bank of Japan some breathing room ahead of its next policy meeting. Today's data release adds an intriguing layer. In March, real wages in Japan rose by 1% year-on-year, marking the third consecutive month of growth. This supports Governor Kazuo Ueda's ambition for a virtuous cycle of wages and inflation. However, cash earnings came in lower than expected at 2.5%. This mixed outcome suggests that while we're seeing an inflationary trend, it isn't accelerating quickly enough to prompt an emergency rate hike. Consequently, US dollar to Japanese yen found a foothold as the US-Japan rate differential remains wide. Recent reports from Reuters and CNBC indicate that the Ministry of Finance likely spent around $65 billion across two rounds of intervention. Yet, US dollar to Japanese yen has climbed back into its ascending channel, solidly above the 154.50 daily cloud. Market commentary reveals a growing skepticism among analysts. A Reuters Tokyo reporter pointed out that the 3-month rise in real wages should theoretically bolster the yen, supporting a case for BOJ normalization. Yet, a strategist from Forex Analytics noted that the US dollar to Japanese yen upward channel remains intact, with aggressive buying at downside targets of 155. Analysts at CNBC highlighted that markets are testing Tokyo's resolve after the two intervention rounds failed to yield a lasting reversal. The prevailing sentiment among institutional desks is that without a clear indication of BOJ rate hikes or Federal Reserve cuts, intervention acts merely as a liquidity bridge rather than a true game changer. For macro traders, this situation goes beyond just currency dynamics. The failure of intervention to lower US dollar to Japanese yen keeps pressure on the JGB curve. As the yen weakens, the BOJ is increasingly compelled to consider earlier rate hikes to defend the currency, which in turn pushes JGB yields higher and flattens the curve. For those trading the Nikkei, the weak yen is a double-edged sword. While it boosts revenues for exporters like Toyota and Tokyo Electron, the threat of uncoordinated MOF intervention can lead to significant volatility spikes, triggering stop losses. Additionally, the ongoing yen weakness complicates carry trades, as hedging costs rise, prompting global funds to reassess their overweight positions in Japanese equities. The domestic financial press, including the Nikkei and Bloomberg's Tokyo Bureau, is honing in on the stealth aspect of recent MOF actions. Reports indicate that the government is increasingly worried about cost-push inflation due to rising imported energy prices, which could erode political capital. There's a growing sentiment in Tokyo that the Ministry of Finance is not merely battling speculators but is also trying to manage the velocity of the yen's decline, rather than defending a specific price point. Analysts warn that if the yen continues to weaken despite rising real wages, public perception of the Bank of Japan's effectiveness could decline, increasing political pressure on Governor Ueda to expedite balance sheet tapering. Current positioning data reveals that leveraged funds have only partially reduced their yen shorts. Meanwhile, real money accounts, long-term investors like pension funds, remain mostly on the sidelines, awaiting clearer signals from the Federal. Interestingly, retail margin traders in Japan, often referred to as Mrs. Watanabe, have been increasing their long US dollar to Japanese yen positions on dips, betting against their own central bank. Additionally, we're seeing potential rebalancing from the government pension investment fund, as the increasing value of foreign assets in yen terms may compel them to buy yen towards the quarter's end. However, until the gap between the 10-year Treasury and the 10-year JGB narrows, the path of least resistance appears to be upward for US dollar to Japanese yen. As we look ahead, pay close attention to the 156.50 to 158.30 zone. This is where the MOF is expected to re-enter the market. On the data front, keep an eye on the upcoming US CPI and retail sales. Any unexpected positive results could overwhelm Tokyo's intervention efforts. Additionally, monitor speeches from BOJ officials regarding the timeline for JGB purchase reductions. In the equity market, the Nikkei's ability to hold above 62,000 is pivotal. Sector-wise, Japanese banks stand out as primary beneficiaries of the higher JGB yield environment resulting from yen defense. Finally, be alert for any joint statements from the G7, as coordinated actions are typically more effective than unilateral interventions. We foresee 3 key scenarios moving forward. In our baseline scenario, US dollar to Japanese yen continues to climb towards 160 as US rates remain strong, forcing the MOF into smaller, guerrilla interventions. The trade implication here is clear: buy the dips at 155, but with tight stops. In a hawkish scenario, if the BOJ hints at a July hike and aggressive tapering, the market could be caught off guard, driving US dollar to Japanese yen back to 150. For this scenario, long JGBs and Japanese banks would be prudent. In a dovish scenario, if the US economy experiences a sharp slowdown, the Fed could cut rates early, allowing the yen to strengthen naturally without intervention. This would favor long positions in the Nikkei as currency volatility subsides. Currently, our AI models suggest a 60% probability for the baseline grind higher scenario, given the persistent interest rate gap. In summary, here are the key takeaways. First, the $65 billion in intervention has not disrupted the US dollar to Japanese yen uptrend. Second, rising real wages provide the BOJ with more leeway to increase rates. Third, keep an eye on the 158 level for the next MOF move. This is a high volatility environment. Stay disciplined with your levels and monitor the yield spreads closely. For daily in-depth analyses of the Tokyo macro scene, don't forget to subscribe to Tokyo Macro. We'll catch you on the next trade.